What's up, everyone? It's Eric from Option Edge, and today we're looking at Amazon. Okay, Amazon has crossed up through its 200-day moving average, which is right here. This blue line that's highlighted. You can see that the other line is a VWAP line, so don't worry about that. But here's the 200-day moving average, and historically, when Amazon crosses up through its 200-day moving average, this has been a good time to sell bull put spreads. Okay, and I'll show you the back test that coincides with this. Let's go over to my back testing software. All right, so I'm using Trade Machine Pro. This is my back testing software that I love to use. And here is the setup here. So we're going to sell the 40 delta and buy behind the 40 delta, the 30 delta puts. Okay, and you can see here is the historical back test, good return of 153%. With 8 wins, 1 loss, average win, that average loss, it's only happened one time, that. And let's see what the let's see what strikes the trade machine took. So let me pause this. All right, the most recent trade the trade machine had was the 5th, so we're going to skip that. But let's look at the technicals, and I've done these fade the dip trades a few times now, but we'll just go over the technicals just so everyone's on the same page. So here it is. We're waiting for the stock to cross up and close above the 200-day simple moving average. Stock has to be already above the 10-day exponential moving average. Usually whenever it's above the 200-day moving average, this is a given just because it's a shorter time frame type moving average. And then this is like, think of the RSI is just like a way of making sure that the stock is not overbought. Okay, and if the stock is below the 200-day moving average, very, very likely it will be below 70 level of RSI. And remember, RSI is just relative strength index, and it just sort of measures whether a stock is overbought or oversold. If it's oversold, it's around below 30. If it's overbought, it's above 70. So that's how it works. And let's look at, I believe, so we can set the closing and opening parameters. So basically closing, when we hit 50% gains, we're closing. Losses, we're letting this thing ride. If it starts to lose, I will sell a call spread against my put spreads if they're losing. And I've made a video about how to defend vertical spreads, and I'll link to that up here somewhere. So that's the main gist. So let's go to Robinhood, and I'll show you how to set this up. All right, we're over at Robinhood. Let's go ahead and trade options. So I don't know if I showed you this, but this is 30 days to expiration. So February 4th is about 32 days. So it's the closest expiry we're going to use, and we want to sell puts. So remember, we're selling the 40 delta, so that's going to be slightly out of the money. So let's see here. That's a 43, and since this stock has so many strike prices. Looks like I got in a little below. So the closest strike to 40 is going to be the 3,345 delta strike. So we're going to sell that one, and then we want to buy behind that the 30 delta, and that's 27. Let's come up here. 3260 is probably about 3,265 would be the 30 delta. Okay, so this thing is, let's just do a quick math. So this thing is 80 strikes wide. Okay, because this strike minus that leaves us 80. So that means we are there's $8,000 on the line minus the credit received, which is going to be $29, or let's just round that to 30. So our max loss is going to be a little bit over 5,000. Max loss will be $5,050. Okay. So, for me in particular, I'm not comfortable with that. I can lose if this is the max loss, expect that is something you could lose. All right. So always want to expect the worst, plan for the best, expect the worst. So what I'm going to do is I am not going to trade the full width I'm not going to take the 30 delta. I'm not going to buy the 30 delta. I'm going to shorten this spread up. We're going to come along. I think I did a 15 wide spread. So here is how it looks. Is that what I bought? Yeah. So total credit. Let's see here. We're going to sell and then buy behind that. Cool. Yeah, I knew that those numbers were off for a second. So this is only a 15 wide spread. So that means that our max loss is going to be 15 minus the credit, which is about 6. So it's about $900. $922 is the max loss on this trade. The max gain is going to be the credit received. And if we play this right, we're going to close out this trade at about 50%. So we'll make just shy of $300 if this goes to plan. And that's sort of basically the setup right there. Let's go back to the back test to see, let's see the new delta that I use. Let's just round that up to 38. Say we use the 34 and 38 delta. So let's go back to the back tester. All right, let's adjust our deltas. We got the 40, let's do 38. Okay. So now we're doing the 40, 38, I believe. So, our return is going to be, our return per trade is less, and our average loss is going to be, less, but our average win is much smaller. So, you got to play around with this stuff. Average return is $13. So it is what it is. The benefit of going with a wider spread is that your break-even point is much, you have a better break-even point and a better probability of profit. But you can lose more. So that's how the setup is. Yeah, that's it. So remember, this is not any advice. This is me just showing and teaching how to put on a put spread in Amazon. And if you're liking this stuff, please like and subscribe to my channel, and we'll keep this baby rolling. All right, peace out.